Look, I'm going to get right to it. A young AI infrastructure company just signed a multi-year deal with Microsoft worth roughly $17.4 billion, with optional capacity that could take it near $19.4 billion. The stock ripped almost 50% in one day. The costly mistake I'm seeing right now is people chasing that gap at the absolute worst time, right when the chart is screaming for a cool-off. If you simply refuse to listen to a random guy hiding his face on a tiny channel. Here is the single most important takeaway. Long term, this news means serious validation that AI compute demand is real and durable for Nebius and for the entire AI stack. Short term, price is extremely stretched, so waiting for structure and letting support levels develop will likely give you a far better entry than jumping in on adrenaline. I'm going to explain both the details of its fundamental story along with the technical picture in the next few minutes. And for those who are still here. Hey, this is DataCat. I used to grind away as a corporate analyst inside a Fortune 50 shop. Think fluorescent lights, endless spreadsheets that don't make sense, and unlimited free coffee. I traded that grind for lasers and keyboards. I'm introverted by nature, so I'll keep this straight and useful. This channel is under 2 months old, so if you find this helpful, yeah, a quick subscribe and a comment really does help me figure out what to build next for you. Alright. Here is the real story of what happened on Tuesday, why it matters beyond the headline, and how I'd think about the trade without getting scratched by the chart. And yes, 1 or 2 cat jokes will sneak in. Consider yourself warned. Nebius announced this massive multi-year AI infrastructure contract with Microsoft. The committed value is sitting at about $17.4 billion, and there's even an option for another $2 billion in capacity, which brings the total potential to over $19 billion. Now, the timeline is a little fuzzy in the reporting. Some say 5 years, others say through 2031, but either way, it's a long-term commitment. And all this capacity is going to be delivered from a brand new Nebius data center they're building in Vineland, New Jersey, which should start coming online later this year. The market, as you saw, went wild. The stock ripped up roughly 50% because investors suddenly saw clear revenue for years to come and, a huge stamp of approval from a company like Microsoft. You have to ask, though, why is Microsoft doing this? Well, it really boils down to 2 things. First is just speed and flexibility. The demand for AI is growing so fast that it's hard to build your own data centers quickly enough. By using a third party like Nebius, Microsoft can scale up its AI capabilities without waiting. Second, it's about multi-sourcing. Microsoft already works with a company called CoreWeave. By adding Nebius to the mix, they diversify their supply chain and give themselves more bargaining power. It's smart not to be the only cat at the food bowl, and that really explains why the market popped so hard. It wasn't just random hype. This deal acts as a huge validation signal. It takes Nebius from being an interesting idea to a proven counterparty. It also gives them revenue visibility, which is pretty rare for a young public company in this space, and for the rest of the industry it was a read-through that confirmed AI compute demand is still incredibly strong. I bet Nvidia's whiskers were twitching on that news. So it's probably a good idea to clarify what Nebius actually is. They don't make software you'd use. Think of them more like an AI compute utility. They provide the heavy machinery, the dedicated Nvidia GPU clusters, the storage, and the services needed to train and run massive AI models. This is a capital-intensive business, and its success really hinges on things like utilization rates, the cost of power, and staying disciplined on pricing. The margins are lower than software for sure, but the demand can be very durable if the contracts and execution are solid. Just to put the numbers in perspective, let's do a quick sanity check. If that $17.4 billion is recognized evenly over 6 years, that's about $2.9 billion a year. Over 5 years, it's closer to $3.5 billion a year. Before this deal, analysts had them pegged at maybe $567 million in revenue for 2025. So, you can see this is a complete step change in the scale of the company. But, and this is a really important but, this deal is not fully prepaid. Nebius has said they'll fund the construction with cash flow from the deal itself and by issuing debt that's secured against the contract. Having Microsoft's name on it helps, but it means they still have to raise that money and then actually execute a massive construction project. And that brings real risk, because building and operating these top-tier GPU clusters at scale is hard. And of course, Nebius isn't operating in a vacuum. Their main competition comes from players like CoreWeave, Lambda, Oracle, and even the big cloud providers themselves. The fact that Microsoft is using both CoreWeave and now Nebius tells you just how massive the need for this kind of infrastructure is. Now, a side note, you might hear some people throwing around the phrase the next Palantir. Let's talk about why that's a bit of a misleading comparison. People say it because they see the big multi-year contracts and the picks and shovels angle for AI, but the businesses are completely different animals. Palantir is a high gross margin software company. Nebius is a lower margin, capital heavy infrastructure provider. So while the meme captures the validation angle, the financial models just aren't the same. Alright, let's look at the chart now, because it really tells a fascinating story here. To understand what happened on September 9th, you first have to know what was happening before the news dropped. This stock wasn't just sitting flat. The midterm picture was already unambiguously bullish. It was in a healthy confirmed uptrend for the prior 3 months, with all the key moving averages lined up and pointing in the right direction. It was a strong non-random trend. But, and this is a key insight, there was a subtle divergence happening under the surface. The volume flow was actually negative, which suggests that leading up to the news, some of the larger players may have been quietly trimming their positions and taking profits into that strength. So you have this healthy uptrend with a little bit of quiet selling happening in the background. Then the Microsoft news hits. It acted like a massive steroid shot for an already strong trend. And that context really explains the wild price action we saw on the day of the announcement. The stock gapped up over 51% at the open on about 6 times the normal daily volume. Yeah, that's a clear sign of institutional interest, a classic gap and fade. It hit a new high of $98.68, but then sold off all the way to $86.12 before buyers stepped back in. That shows a big tug of war between the euphoric buyers and people taking profits. Right now the stock is very stretched. It's sitting way above its key moving averages, and the RSI is deep in what I'd call nose against the window overbought territory. This kind of extension is usually unsustainable. So how would I think about this from here? Obviously this isn't financial advice, just how I frame the risk. The most likely path forward is some consolidation, either trading sideways or drifting a bit lower to let things cool off. The key level to watch on the downside is that intraday low around $86. If it holds above that, it's constructive. A deeper pullback to the $70 to $72 zone would be a significant correction, but that's the area that would start to look like a much lower risk entry point to me, as it would start to fill that massive gap. On the upside, the level to beat is that all-time high of $98.68. A sustained break with noticeable volume above that would signal the trend is continuing. Ultimately, the big story here is that the demand for AI compute is still roaring, and Microsoft just gave Nebius a massive vote of confidence. But in the short term, the price has run ahead of itself. If you feel that urge to chase, just remember, when you wave a laser pointer, the cat sprints first and thinks second. Don't be that cat. Wait for the structure to build, confirm your support levels, and let the data, not the dopamine, guide your decisions. If this helped, I'm DataCat. I keep it modest, I keep it data-driven, and I try to save you from paying tuition to the market. This channel is still under 2 months old, so yeah, hit subscribe if you want more no-nonsense breakdowns, and drop a comment with the tickers you want me to cover next. Alright, DataCat out, stay safe and stay sharp out there.